Good morning and welcome to today's webinar at East Capital Group, focused on the Nordic bond market and more specifically the Nordic corporate bond market. My name is Marcus Rågmark. I'm a member of the sales team here at East Capital Group. Stefan is responsible for the fixed income portfolios at East Capital Group, and we will also have Erik Karlsson with us. Erik recently joined us after 10 years at Standard & Poor's as a credit rating analyst. Welcome to you both.
Thank you very much.
So before we look ahead, I thought I would just provide a brief recap of 2024. When you and I stood here, Stefan, about a year ago, I know that you and the team had a fairly conservative outlook, and this was also reflected in the positioning of the fund with a fairly short interest rate duration, low credit risk, and particularly an underweight to the Nordic real estate sector. And this was due to the continued high interest rate levels and relatively weak consumer demand. And I know you're also targeting a return in line with 2023, meaning roughly 7 to 8% in euro terms. And that's also what you delivered. And this brings total return since inception in excess of 15%, which I think is a very stellar performance. So with that brief introduction in mind, how would you summarize the year 2024? Was there anything which stuck out and surprised you, perhaps?
Yes, it was. So it was a risk-on environment, something you can see on the chart here in the picture. Credit spread generally tightened, more so when it comes to high yield compared to investment grade. The speed and the strength of the real estate recovery was something that was stronger and a little bit unexpected, that it would be that fast. It can be viewed from a lot of inflows in the funds, supportive banks and owners that actually capitalized the real estate company that they owned. We had an exposure of around 10% going into last year. We slowly increased that exposure to 20% at the end of the year because we don't like binary risks. And the kind of risk the real estate sector has is the interest rate risk, which is an exogenous risk that themselves can't have any meaningful influence on. And that goes both operationally and financially through the valuation of the real estate. And also if you look at the issuance level, which has been fairly low the 2 years before, that actually exploded during the last year. So there was a refinancing demand that actually were meeting the inflows from investors going into usage funds. And the long-term interest rate, even though we are talking about lowering interest rates in the last year, the long-term interest rate actually went up, like you can see here in the picture. And here you can also see the dramatic effect of the real estate risk credit spread going down from more than 1,000 bips to now 370. Also, if you look at the real economy, unemployment didn't go up, which is something that took us by surprise. Generally, when the interest rate goes up and the central banks fight inflation, unemployment goes up. But this time, companies in general took a higher cost of retaining employers at the expense of margins.
Thank you for that comprehensive run through, Stefan. And in terms of investment and allocation decisions, obviously there were many, but are there any in particular that you'd like to highlight that you made throughout 2024?
I think it's important to understand that we focus heavily on risk when it comes to investment. And when you have an interest rate environment that is having a higher interest rate, that translates not only to financial risk, but also to operational risks. So what we did was trying to invest in company where we had visibility, earning visibility. And that meant that we were investing into companies that generally were stronger, larger, and had more products and were more diversified than a typical high yield company. So even though we were generating or allocating capital to those companies, we were generating a return in line with what we were forecasting the year before. And then the central banks, ECB and the Swedish Riksbank, for instance, were starting to cut rates just before summer. Then we were slowly increasing the risk in the fund, because then we were talking to companies, to management, asking them about visibility and orders and etc. And then they were painting a little bit more bright picture. And that was the time when we were increasing the risk.
Okay, thanks. And I think that's also key to highlight really with this fund, that you and the team have very close relationships with management teams, both here in Sweden, but also in the Nordics, which enables you to get this sort of first-hand insight and help in investment decisions. So despite the strong performance, of course, we're always trying to become even better and improve. So are there any particular learnings that you bring with you into 2025?
Yes, but first of all, it is. But we can say that the management process, it works, and it serves as a framework to balance risk and opportunities. And I think we've shown it works in bad times and in good times. What we missed was the impact maybe of the large inflows into the market, generating the speed of the recovery we saw, particularly when it comes to real estate market. And that is something that we might need to look further into and see how we can incorporate that into our process going further. And some of the bonds in the real estate market was generally non-performing bonds at the time. And we have seen a performance of around 200% in a selected kind of bonds. That is not where we generally want to be. We want to be invest into bonds where we actually see a business model that works. We don't want to have this kind of binary outfalls where if it works, you will get a stellar return. If it doesn't work, there is a hard bankruptcy. So some of kind of performance we saw from the real estate sector was not and will not be something that we are investing in this kind of fund anyways. But we were investing and we have increased exposure, but the exposure is increased generally to the larger, better name in that sector.
Sounds good. So still adopting a fairly conservative approach, even though we add a little bit of risk, basically.
Yes.
Good. So that's 2024. If we look ahead, what would you say, what's your outlook for the Nordic corporate bond market for this year, and what will have the largest impact?
Yeah. So I think one of the interesting things here is the central banks is a little bit out of sync for the first time in several years. When they were raising interest rates, everybody was doing it on a global level. And now we are in a time, even if you look at just the Nordics, actually you look at the Norway, they haven't lowered interest rates yet. They were talking about lowering it in possibly December last year. They didn't lower it in January. Now they are talking about maybe in March. So you have central banks going into different kind of speeds here, which can affect capital flows in a way that is kind of hard to predict, and obviously currencies. But looking at 25 compared to 24, obviously we can't expect spread tightening to be the same this year, especially when it comes to the real estate sector. That was tightening from more than 1,000 bips down to 370 today. There is not enough spread for that to happen. But that doesn't mean that the performance will be bad, but we can't expect that kind of wind tailwind going into 25. And looking at the Nordic high yield particularly, where you have a lot of unrated companies, the spreads are generally higher, both than European markets and the US market, with around 100 bips per year. And finally, yes, something that we looked at before this meeting, spreads between different kind of sectors are pricing in the same way, which is kind of strange, because you would find another pattern if you look at the equity side instead of looking at different kind of sectors. That's something that we will look further into going forward.
Good. Thank you, Stefan. Great answer, but nevertheless, we will now make a substitution here in the studio, but I might call you back. So please welcome Erik.
Thank you, Marcus.
Hi, Erik. So as I mentioned in the introduction, Erik Karlsson recently joined East Capital Group after close to a decade at Standard & Poor's as a credit rating analyst. So he knows a thing or two about evaluating risks. So with that in mind, what are the most important risks, would you say, for investors to be aware of for this year?
No, I think a few things perhaps, but I think we might start with we might have events impacting the risk appetite for investors. That might, for instance, be related to geopolitical risks, for instance, related to the Ukrainian war. We have uncertainty on the political direction in the US and perhaps the relationships with trade partners, tariffs, relationship with China, etc. And I think that might cause, if we have a negative event there, you might have capital outflows related to the funds, you might have credit spreads widening, you might have, we might see the access to the credit markets become weaker for companies, and especially the financially weaker ones. And you also have, I think there's also a macroeconomic concern. If you look at, for instance, the private consumption in Sweden, which is a driver for GDP growth, it hasn't recovered despite the fact that inflation has come down. We have the short interest rates are down as well, and I think that's something to keep an eye on and to see if it recovers. Otherwise, that's a concern.
Sure.
And if you,
do you expect consumption now to sort of recover now in Sweden this year, or will it?
I think it might be a lagged effect. If you take the interest rate, it takes some time before it hits the mortgage rates and so on, or the impact on the lower mortgage rates, sort of ending up with the consumers. So there is probably lagged effect, and we'll see. But the interest rates are down, inflations are down, so there is prospect for it at least. I just wanted to also say that if you look at the companies, the credit quality of the companies has actually improved for the past year, supported by the recovery in the economy. But I think there is a mixed picture to it also. The different sectors face different challenges. And if you take real estate as an example, for instance, where we previously talked a lot about refinancing risks, we're focusing a bit more now on the operating side, and where you, for instance, have higher vacancies for office space in several cities, including Stockholm. And that's, of course, something to keep an eye on. And if that trend isn't reversed, some companies might end up in difficulties.
No, indeed, and I think that's a good point. I think it's easy to think of real estate as purely a financing game, but clearly the operational issues are there as well to consider.
Yeah.
Good. Thank you, Erik. Any further risks you'd like to highlight?
No,
those are the main ones.
There are a lot of risks, of course, but I think those are the main ones.
Great. Thank you so much.
Thank you.
So with that, we'll bring Stefan back in then. So as we heard from Erik, there are a number of risks, and the market is constantly evolving and changing, seemingly at a more and more rapid pace. So how are you and Erik and the wider team able to adapt the fund depending on the market conditions?
So we have a fairly broad mandate in the fund. However, we're not using that in order to take the risk and then try to drive as fast as we can in terms of how we invest. We have a process like we have been trying to talk about a little bit today, and we adjust over time. It's important for us that our investors feels comfortable with the kind of product they invest in. You will see gradual changes rather than quick dramatic ones, so that the product you invested in will still be the kind of product you are still invested in the future. And this is a crossover fund, and you could see historically this is the kind of highest risk adjusted return you could generate by actually investing in these kinds of funds in a global context and also in a Nordic ones. And we are using, or we are investing into high yields in order to generate an excess return. That's an alpha source for us, and that's important, because if we don't feel that we will get this kind of extra return from the investment in the high yield space, we would rather invest somewhere else. And that was something that was happening in the beginning of last year, for instance, when we're thinking, the risk is a little bit high. We're not very sure on the direction here. It can go good, but it can also be going in the opposite direction. We were taking risk down just in order to make sure that we understood the risk. And when we were thinking, okay, now the risk is actually going down, then we did some changes and increased the risk. And that's kind of the way we're trying to work. Everything is about risk. Everything is about controlling the risk and only investing in things that we feel that we have a deep understanding of.
Thank you, Stefan, and I agree. I think that's the beauty of the crossover fund and the flexible mandate that we have to sort of adapt between investment grade and high yield depending on how we see the market. Good. So as I mentioned, 2 very strong years behind us, both 2023 and 2024. With that being said, we see quite good conditions for 2025 with a continued fairly high interest rate environment. So what do you expect for 2025 in terms of returns, and how you think investors should view the relationship between equities and rates going forward? Will fixed income again be a healthy source of diversification for investors?
First of all, yes, I think it will be a healthy source of diversification. You have different value drivers when it comes to bonds compared to equities. And in this kind of environment, if you look at our fund, you have a yield of around 6% now. So you can expect maybe a return on a 1-year horizon of 5 to 6%. That's our best guess. And you have an equity market that is valuation is kind of elevated. So maybe you can expect a little bit higher return in a normal scenario, but the risk is also a bit higher. And I would say, yes, the way I see the bonds and the equities at the moment is you get like 2/3 of the return of equity in a bond portfolio at a 1/3 of the risk, which I think is very, very compelling at the moment. So you could significantly decrease the risk in a mixed portfolio by having bonds and equities together, but not at the expense that much anyway of the total return. So obviously I think it's super, super interesting.
Good to hear. And it sounds like the risk reward profile then is still very attractive in your view.
Yes.
Very good. So with those closing remarks, I think we'll round off there. So thank you, Erik and Stefan, for today. And thank you, of course, to all our listeners for listening in. Hope you found it useful. And as always, please don't hesitate to contact either myself or one of my colleagues if you have further questions, and we're always happy to set up individual calls as well to run through the fund. Thank you so much.
Thank you.